Greetings, members, one and all of the Salivation Nation. Inflation rises again. Gold and silver are down. Why is this happening? Let's explore. Folks, many are perplexed as to why, in times like this, when we see inflation rising above expected levels, that gold and silver would go down in this time. I'm going to be referencing two articles from Kitco that brush over what this is about. I think there's more to it also than what is being discussed in these articles. We're going to talk about that as well. But it is perplexing indeed. And I think this is something that has baffled those who make these vast predictions about gold and silver going to the moon in times like this. But there's a lot of psychology in the markets. This is one thing that I've been consistent about, and that is the power of the natural markets. Natural market forces play a huge role across all spectrums of the economy, including the prices for stocks, bonds, Bitcoin, NFTs, so things that are fungible and other things that aren't. And that's just it, folks. Psychology and emotion plays a huge role in prices for goods and services, as well as for stocks and bonds and the like. And the precious metals are not immune to that psychology. Yes, they do protect us from inflation. They also protect us from deflation, which is why I always say that gold and silver protect us from economic instability, rather than saying that they just protect us from inflation. Although today, it's very hard to make that argument for how gold and silver have reacted to this latest news. But I think we'll have some better understanding of this when we look at the emotion behind the trades today. The gold market continues to see some technical selling pressure and is finding little bullish traction following this hotter than expected inflation data. The U.S. Labor Department said its U.S. Consumer Price Index, the CPI, rose 0.6% in January after a 0.5% rise in December. The data beat consensus forecasts as economists were forecasting a 0.4% rise. So even as such, they knew it was coming, just not to the extent that we are seeing right now. So for the year, the report said that headline inflation rose 7.5%. And we do remember that it was just above 7% before. Annual inflation was also much hotter than expected, hitting a new 40-year high expectations. Some economists were bracing for an inflation to rise to 7.3%. But it blew past that. The report noted that rising food prices, energy costs, and shelter costs all rose last month. Food prices rose 0.9% last month. At the same time, the energy index rose 0.9% as electricity prices offset a drop in fuel prices. So meanwhile, core CPI, which strips out food and energy costs, increased 0.6% last month, up from a 0.6% increase in December. That was the seventh time in the last 10 months it has increased at least 0.5%, the report said. There goes that transitory inflation or temporary inflation that they tried to revise at the last Fed meeting. For the year, core CPI is up 6%. The report said annual core inflation saw the largest 12-month change since the period ending in August 1982, which, by the way, in 1982, our national debt was sitting around $1 trillion. It has increased $29 trillion since then. We've come a long way, baby, and it's not a good thing for sure. The gold market is not seeing much reaction to the latest inflation data as it sees some technical selling pressure after Wednesday's push above initial resistance at $1,830 an ounce. So that could be one reason why the prices are down for gold, at least. April gold futures last traded at $1,824.40 an ounce, which is down 0.66% on the day. Some analysts note that the gold market is unable to catch a bid because the latest inflation data is rising expectations for aggressive Fed action next month. Calls for a 50 basis point move in March continue to solidify, and markets are now pricing in the potential for 6, not 4, but 6 rate hikes this year. Wow. The broad-based price increases solidify the Fed's hawkish stance and add to the urgency for rate hikes, says Catherine Judge, senior economist at CIBC. Andrew Hunter, who's a senior U.S. economist at Capital Economics, says that January's inflation data could represent the high water mark for the year as global supply chain issues start to ease. However, he added that while prices are close to peaking, they will still remain elevated through 2022. While we expect more favorable base effects of the partial easing of supply shortages to push core inflation lower this year, this suggests it will remain well above the Fed's target for some time. And this may be some of the reason why governors and even some of the administration are saying it's time to end mandates, it's time to ease restrictions based off the coronavirus moving from a pandemic to endemic status. Jim Wyckoff also wrote an article here that talks about a little bit of this. The U.S. data point is Thursday morning's Consumer Price Index report for January, which is up 7.5% year on year. The marketplace expected it to be 7.2. It's the U.S. hottest reading since 1982. And the data falls into the camp of the U.S. monetary policy hawks who want to see an aggressive pace for Federal Reserve interest rate increases this year. U.S. Treasury yields spiked higher after the report, which is helping to pressure the metals markets. So that is another key index here. So they are saying this is going to push them to further commit, or that they will definitely be doing this now because inflation's running hotter, which means that Jay Powell and the Fed have got to use their tools. And their tool at hand right now is going to be these rate hikes. And that could send gold and silver falling even more or keep it where it is. Now, I believe that the prices will actually rise for gold and silver after they raise these rates, because they will see that it probably won't have much effect on inflation. It's running hot. This is why, folks, that I thought maybe they would act sooner when they had their meeting last. That I thought that maybe they would go ahead and raise it a half a point then, which would have probably have shocked the markets and maybe even brought the prices down and helped to stave it off then. But who knows? Many people say that they can't raise interest rates at all because it would send the economy into a tailspin, stagflation, and all sorts of other things that are happening. Interest rates for mortgages and other things are already rising because of inflation. And so we're starting to kind of see it on that end. But nonetheless, the Fed has not acted yet, and March is still a ways off, because I think that meeting is going to be around the 16th of March when that's going to occur. So essentially what's happening here is psychology. The markets are well at work here, folks, and it's baked in. There's a baked in to what they're going to do with prices, with the interest rate hikes, and they know it's coming, and so therefore they're anticipating it, which means they're hoping that gold and silver will probably stay lower, and the interest rates will rise, and they're all giddy about it because they know the Fed is going to save them. That's right, folks. That's what the market is hoping for, is that the Fed is going to act, and this just gives them all the more leeway to go ahead and take that action. And but what does this really mean? As inflation maybe pulls back a little bit, is what they're hoping. That means the dollars that the Federal Reserve have been printing will hopefully be worth at least a little bit. They won't lose value as fast, but they will continue to lose value. Make no mistake, that is one thing is for sure. But if they can squeeze as much out of this dollar as possible, they're going to go for it. And they're all giddy about it Because remember, what's been happening since about September of 2019, definitely noted October and November and December, is the repurchase agreements. All that money being printed and loaned out and given out to the big banks. And that has been happening. Some say it's still happening. In fact, I heard this morning, I cannot verify it, but some say it's to the tune of a couple of $1 trillion every couple of weeks, which is insane to think about. That's why I can't verify it, but I heard that. But I don't know. I want to say if it's true or not, but I think the numbers are off. But I can't imagine that we're spending that much every couple of weeks to the banks. And it's just insanity. Absolute insanity. But nonetheless, what is it about? It's about emotion. And this is why there is an index for this. The fear index, the volatility index is a measure of all this. And so when that goes down and the dollar index goes up, everybody's happy. Yes, you can have a strong dollar and it continue to lose value at a faster pace. It has lost now 7.5% compared to last year, year over year. It's insanity to think about. And some say that we can see it can go up even higher, 8%. Some say even as high as 10% before this year is out. Nonetheless, a solid 40-year high for inflation is what we're dealing with now. And it looks like there's no stopping it. It is up higher than expected. And it just goes to show you that this thing is certainly not transitory. This thing is going to be with us for quite some time. How else can we interpret this? What is the cause of this? Well, supply chain issues, sure, yes. Because of the coronavirus pandemic, yes, I agree. There's other natural factors that can come into play with increased inflation, but the vast majority of the blame falls with the Federal Reserve and to government, to Congress, politicians, allowing the spending and massive spending, repurchase agreements, quantitative easing, and this easy money, this modern monetary theory that's hurting us all, folks. There's where the problem lies. That's the major culprit here. And that's why we stack gold and silver, folks. Gold and silver are not affected by that. Just the prices of them are. And the prices are going to reflect, sooner or later, they're going to reflect this inflation that we're seeing. What is it about? It is about being patient through these times when the prices actually fall after getting news that inflation is up higher than expected. This is the time that we must be strong and hold on to the gold and silver that we do have, and to understand that it does actually create a buying opportunity. But understand that whenever you do buy, there is a possibility that the prices could actually fall after you buy. Even in this crazy time we live in, yes, it could happen. We don't want to discount the idea that it won't, because it could. That is the thing and reality that we live with today. It is an alternate reality because under a normal reality, these gold and these metals you see before you here should be rising in this case. And when you compare it to where they were in 2019, they certainly have. And one can make the argument, though, whether or not they have kept up with inflation yet, because inflation is running hot and gold and silver are not. But they will. They'll catch up. Mark my words on that. So there you have it. Let me know what your thoughts are in the comment section below. I want to extend a multitude of gratitude to you all for taking the time to watch. And I know I say that at the end of all my videos, but it is the tagline and slogan for my channel. And I mean it from the bottom of not just my heart, but all of my organs. I appreciate every single one of you being here. It means a lot to me. This is a great viewership here and a great community. And I do want to extend that multitude of gratitude to you all. And I also want to encourage you to please rate this video. That means to thumb it up or down, whatever your preference is. I do appreciate that as well. It helps the engagement and it helps to get the word out. Share it with all social media platforms that you feel inclined to. And comment and subscribe.